Welcome to this evening's Traders Group. Let's just start with a little bit of background on trade wars between the United States, trade wars between Europe, United States and China. This is what I hear. We spoke last week about the Europeans' willingness to negotiate a zero tariff deal between the two countries, and they don't want to go down the path of anything to do with protracted tariff wars. And today, China announced the same. So not that they announced a zero tariff between two countries, but they did announce that they're willing to open negotiations and talk. So please don't interpret my comments as pro-Trump. All I am suggesting that his overblown talk about tariffs was a strategy and it worked. And it is to the benefit of the United States, and I think it's to the benefit of us, possibly, maybe indirectly negatively if it deflates the Chinese economy a little bit, but his strategy worked. So all that negative news of trade wars, for the uninitiated, was all about, it was fear, and it generated a lot of fear within the markets. But as we are well aware from the perspective of an investor or a trader, we are investing and trading in what we're looking at and analysing, not what we're listening to, because what we're listening to is often in direct contradiction of actually what's happening, which is completely confusing to the uninitiated. That's why most people can't trade, because they can't segregate what they hear to what they see. And I've got a huge body of knowledge which is all about just observing the market from the perspective of volume, price movement, and quantitative strength to analyse the likelihood of a market continuing in a particular direction. So here we are, months down the track from the February low, and we're still tracking up. And last week I suggested that the market was extended significantly above its trend line, which, as we well know from previous discussions, predisposes it to reverting back to its trend line. So now we're 5 days down the track. What's it done? Well, it's reverted to its moving average in the past 5 days with a extremely high probability, in fact, a certainty of breaking through that moving average and continuing on with its counter trend. Last week I suggested that this is not the time to go long. It's not the time to go long shares. It's certainly not the time to go long options. When I say long options, I mean long call options. Of course, you could have gone long put options, but in the case of upward moving markets to make money, that's not what's occurring, and it's not what's going to occur in the next week or so. Going back and looking at these counter trends in the past, the market has been rather symmetrical. I'm not going to suggest that symmetry continues. Roughly speaking, though, it's been having 12 to 13-day pullbacks, and we've now had a 5-day pullback. Hence, there should be a lot more to come in terms of this continuing pullback. What supports my view that, and why I don't want to use the word I'm 100% sure, but we have been here many times before. In fact, we were here just last month. We were talking about exactly the same thing. And what, though, makes me very sure of what I'm saying, or with a high degree of certainty, is that the buying volume that supported that rally and that extension, which was above its moving average last week, has dried up. So is there positive buying volume to be observed? Yes, there is, but it's gone down to less than half. Another point that I made up last week was looking at the previous ranges. If you remember the discussion about ranges, I finally decided that the range it should be was either the small or the large range, and the large range was the one that the market touched, slightly broke through and starting to reject. So where is the market going to go from here? It should do a division of its Fibonacci range. So if we just divide up the range of this particular move to the upside, we grab a Fibonacci tool, grab the low, grab the high, you'll see the market pull back to the, usually if it's a very strong market, it'll be 0.382. If it's a medium market, 0.5, and it's just a slow momentum market, which it is, you should expect it to pull back to 0.618. Is that for certain? No, it's not for certain. They're just targets on a screen where we start to observe price action and volume behavior to define whether that is actually the low. So what else is telling me that this market is probably tracking to the downside? In addition to just raw volumes, I do have obviously new high, new low information. In terms of new high and new low information, last week there were 27 new highs, 3 new lows. This week there were 25 new highs, 4 new lows. Nothing changed. In terms of advancing and declining numbers of shares within the S&P 500, last week we had, 3 weeks ago, I'll go back 3 weeks, we had 298 advancing, 186 declining. Then last week I pointed out that right at the top, right at that breakout, there was 261 advancing, 221 declining. So something that I pointed out last week, that we were breaking out, yet the advancing stocks had declined, not dramatically, but it's interesting that volume's dropping away as the market's breaking out, which indicate it's not sustainable. And then it's followed through to this week where we've got 243 advancing, 240 declining. And that slight backward trend will occur as the counter trend occurs, and then we know it'll reverse. I mentioned all the time, it's not the numbers, but the volume of the numbers, which I find interesting, and the percentage of buying volume above selling volume in relation to advancing and declining stocks. 3 weeks ago, when the market was starting to have its extension, the buying volume was 49% above selling volume. Last week, it was 5%. That is, buying volumes of the advancing and declining was 5% above selling. This week, it's 1.6. So we can see that the advancing volume is getting less and less. And as this counter trend continues, it can actually slightly reverse, but not dramatically. And then it captures leadership as the market starts to move up. So this is a fairly regular cycle. And the cycle is fairly, I believe, preemptible in the context of this market. And it has been good. In fact, there's one client in this room, he's not here, he's in Europe at the moment. He made a lot of money on that last move, and like an extreme amount of money. So this, I'll just repeating myself, this is not the buying time. This is not the time to be a buyer of anything. Yes, this is a time to be sitting back. If you're doing the SPY methodology, it is a time to be taking a sold bear call spread position. That would be something that you could be actively engaged in as the market pulls back, and that should occur for at least the next week. So is there trading to be had? Of course there's trading to be had, and it is easy to take advantage of. Okay, I was just distracted there. Moving across to IWM. Looking at IWM. IWM has been interesting because it's usually the most sensitive of the indices, being the mid-cap shares in the United States. When I looked at this 2 weeks ago, I noticed there was a failure to take out a previous high and a break to the downside. That break to the downside should continue down to the trend line in alignment with the pullback of the S&P 500. Is that anything significant? I don't believe it is anything significant. It's just a market which is doing a very strange three-wave structure and a counter trend back to its upward moving, sloping trend line. Okay, so how does that factor in on all other indices? Just before I jump off SP 500 and comparing it to IWM, I just make note that it had a significant decline in its buying volume behavior. So that indicates a continuing counter trend coming up in the next week. I'm just going to put up QQQ. QQQ's in relation to the tech. Tech has had a pullback, but it's been restricted to the media focused, social media focused companies like Twitter and Facebook. We know about Facebook last week, had that 20% decline, and that decline continues. I thought it may have had a much bigger impact on tech generally, but it didn't. It was restricted to just this one sub-industry within the tech sector, and obviously a closely aligned share with that is Twitter, and it also had a massive move to the downside and continues to do so. With Facebook, I probably think the worst thing you could have done is buy put options as that market fell. That would be really, really silly. And the reason that would be silly is because you would be buying overinflated puts. And as the implied volatility declines, you can't make money doing that. So, and I think everyone knows that just because a market collapsed 25% doesn't mean it's going to continue. And even if it does, you've already bought overinflated puts, which are not going to make you dough. So, where is Facebook going to go to? I think it's probably going to continue to the downside. It's got a little bit to go. There's a trend line down at 160, so it won't be surprised for it to get there. That would be in alignment with the pullback in the S&P 500, and that would be a great buying point if you want to invest in Facebook. That would be a point where I'd start to get, buy some shares and buy some exposure into Facebook, technically speaking. It would be a great point. Mike, I will email you some information tomorrow. If you don't get an email from me, I'm just reading your comment. Please follow me up, chase me up. Okay, so let's go look at some other indices around the world, primarily focusing in on Europe and looking at other major economic blocks. First of all, EWG. I've been avoiding the EWG chart, but I think I better just stick and start watching it again. When I look at this EWG chart, it does look like, and I have drawn this previously, a inverted head and shoulders pattern, which is slowly but surely coming to pass. Had a huge collapse, it's having a rise, and that's building a slow base. The DAX should reflect that, and it does. The DAX, it looks very messy, but it's on a weekly chart. It's an extremely large W pattern, and we've drawn this before with the market pulling back to 0.618 of its previous range, and is starting to go up. Nothing unusual. And that go up, I could replace the go up with a trend line. It's looking fine. Maybe come back a little bit more. Nothing unusual. Looking good. Just looking at the volume of the DAX, I've only got volume of EWG. It has been steadily positive in the past 3 weeks with increasing intensity. Therefore, this move in EWG to the upside is supported by institutional buying behavior. Therefore, I would suggest it's got plenty to go to the upside as I stand here today. Let's compare against EWG against the other major economic region or major index I like to follow, which is the Shanghai Composite. And I need to blow this up a little bit. We also are aware that Shanghai Composite had a very, very large fall. And those very large falls often resolve themselves in inverted head and shoulders patterns. That said, I believe I did this last week, but I wiped it out, so let me draw it back in. This market has had a rally. This is very crude. It has had a retest. It has had a confirmation of what would be some may consider to be a W pattern, but I have pointed out that it's a little bit premature to call that because we need to see what happens with this current pullback. If this current pullback continues, this is not going to be a W pattern, it's going to be something else. So this pullback has already reached 0.618. And if it breaks below 0.618 and breaks below the right-hand side of this pattern, you know what it's going to end up being. It's going to end up being an inverted head and shoulders pattern. So maybe not as dramatic as what I'm drawing. So would I commit myself to FXI at the moment? No way. Although that said, when I look at the volume behavior, there is a little bit of positive volume kicking into the market, and by all accounts, it may turn out to be a W pattern, but it simply is just a week out or 2 weeks out before you can call that as a low. Coming across to the actual Shanghai Composite chart, we should see a base forming on the Shanghai Composite if that's all a true statement. And I don't see a complete base formed on this. So if I go draw in what I had last week, which was a test of a low, a retest, which looks like a potential W pattern, you can see, as much as I can see, that the pullback has gone greater than 0.618. What's that? Red flag. Although, yeah, no, there's nothing about it. This is screaming that it's probably going to continue to fail, and that continuing failure would indicate a potential inverted head and shoulders pattern. It's still a little bit early to call, but after tonight's price action, if you see it break, continue on the way down, it is what I've just drawn. That's actually not good for metals and mining, and I did notice a little bit of softness on metals and mining, so I was preempting a bottom in metals and mining, coinciding with a bottom in the Shanghai Composite, and also a bottom in. Remember, we were talking about copper last week. Maybe it's a little bit early to be calling this. So coming over to copper, because it's on my screen, it's copper futures. I really need to dig up an exchange traded fund of copper so I can analyze volume. I can't and don't have volume behavior on futures, so this looks like it's nothing at the moment. It's probably going to fail. If it is highly correlated with the Shanghai Composite, which it is, and we're thinking Shanghai Composite might fall again, or copper will go with it, as it always does. So, Shanghai, China undecided. EWG, Germany looking good. Let's come across to our local indexes, starting with EWA. I've been avoiding these exchange traded funds, but I'm now comfortable to come back and have a look at them because time's moved on and there's some interesting, I suppose, short-term patterns evolving within this market. I start to see markets that are having, multiple tests of highs and then start to, struggle to the upside and form these triangular patterns, which are patterns which usually resolve themselves in a break to the upside. It's called an ascending triangle, and I believe that's the most likely outcome of this particular market. Why do I believe that? Because EWA, the Exchange Trading Fund representing our market in New York, or NYSE, sorry, is supported unusually by a major shift in institutional buying behavior in the past 2 weeks. In fact, it's actually quite dramatic. It's been positive for 4 weeks, but it's building in strength. You can't see that on the chart because it just looks like an ascending triangle, but there's a lot of institutional engagement in this particular chart. If you look at the composition of EWA in the US, break it down into its components, it's predominantly banks and mining companies. That's what it represents. So that should mean that our market is looking kind of bullish. And if we open up a chart of XJO, I believe it is. No, it doesn't look like it, but just give me one moment till I draw in the pattern. So we can draw a trend line going through the bases, and we can draw a trend line going across the tops. Every time I think the market's about to break, I get very excited, and I tell people I speak to, please be patient, because it's tried to break that top trend line now 3 times and has collapsed back to the upward sloping base of this pattern a number of times, and here we are again. So what would be concerning, I suppose, would be it significantly breaks to the downside out of this triangular pattern. I don't think that's what's going to happen. I still believe there's time for this to still contract up sharply. Usually these triangular patterns, I haven't drawn it very accurately, but they break 75% of their way into the pattern, and this market hasn't done that just yet. Other bits of information that tell me that this is going to have a significant break when it makes its move is the choppiness index. If I bring up the choppiness index, which I don't mention very often, I had a look at it today, and the choppiness index is situated way above 0.62. What that means is, the best descriptive way I can describe it is energy has built up and it's about to be dissipated. And this choppiness index gravitates up into the 60s when that happens. So it's not a timing indicator. It's just an indicator of pent up sidewards accumulation, and it's saying it's going to break hard. Can that break be to the downside? Absolutely. So I'm not suggesting direction. It's a non-directional thing. It's just our energy build-up type indicator that tells me when we do have a break, it's going to be significant, and that's interesting. I obviously believe, or my belief is, because I'm long the market, that we're going to have a break to the upside. When that break occurs, what I need to see to confirm a break, unlike the last 3 times, I need to see a market actually jump outside the triangle, and then I just need to see a confirming day. And that's exactly what I've been saying to itchy-fingered index traders within Australia. Please don't be sucked in by these closes on the high, because there's been now a number of them, and every time it's got there, I've said just wait one day. Then the following day, it reverses and goes back inside the triangle. So this is very, very interesting and is a great opportunity, not just yet. Other bits of information backing XVI. I just want to go back to the VIX. This is the Australian VIX. And what I'm looking for is any significant signs of increased institutional put buying, and the answer is I don't see any such thing. So I'm just looking at this. It is in a sloping downward pattern. It probably, may break out of here a little bit, but nothing significant. Although I do obviously observe, and you can observe, that there was a very large rise today in the VIX, which means there was a bit of put buying on the VIX today, and that I suppose is not unusual because it broke back deep into that triangular pattern. While I'm on the VIX, let me jump across to the United States VIX again. I'm looking for any unusual activity that could indicate that this market is about to do something crazy, like have a major break to the upside. All these spikes on screen represent the 3 pullbacks over the May, June, July period, and this will be no different. So if this market continues to have a pullback, that is, when I say this market, I mean S&P 500, you'll expect to see a spike which is equal to or slightly greater than the last 3 spikes, representing the normal movement of the market with a little bit of fear creeping into the market as the market still is tracking to the upside in a very low momentum pattern. So in summary, where are we? Things are bullish, things are good, fundamentals are great still. Of course, you read the fearmonger stories, but a lot of the stories that I'm reading are based on economic discussions which have lagging implications years into the future. And one of the ones, the often touted stories, is interest rate rises in the United States will create a top in the market. And it's great, it's wonderful, and it's all based on inexperience because it's got a 2, 3, 4, 5 year lag on it. So it doesn't mean it's going to happen anytime soon. Do rising interest rates eventually choke off a bull market? Yeah. Increased cost of capital? Yeah, we all know that. But it's just such a lagging effect. I think this is looking really nicely, nice trend up to the upside. It's not a dramatic move, but we're about to, on the next extension, what are we going to do? We're going to break into a new high. That break into a new high will encourage new entrants into this bull market, because this big sideways move, as some people may look at it as a big sideways move, is based or has been built on the back of fear coming out of the White House. And I did a survey recently, and a part of the questionnaire in that survey was, where have you got your money? And interestingly, 71% of the respondents said they got their money in cash. Why? Because they're scared, which is kind of weird because I'm fully committed. I see no sign of any form of topping behavior within the market other than short-term counter trend. And the only thing that would draw me into the, not the fear zone, but the I need to do something zone, would be a break of trend, a break and a trade below a swing low. And that's fine. I'll react if that happens. So I'm never, ever, ever am I fearful of markets collapsing because it's silly nonsense. Um, am I attempting to pick the top of a market? No. How can I do that? Am I trying to pick bottoms of markets? I'm talking about big time frames. No. But I'll never ever be in a position, and you should never be in the position where we're at the top of like 2007 and you're staying right it down for 2 years. That would be incredibly silly of you to sit there with all the knowledge that everyone has in this room. Just give me one moment. I need to read a comment from Alan. Brian, I'll do ANZ. Just give me one moment. I'm just going to read some very insightful commentary from Alan. That's New Zealand Alan. And that is, Alan's just giving me a textbook definition of ascending triangles. And I think it's timely because they're all over the place. So I'll just read out what Alan's just given me. He states, the ascending triangle is a bullish formation that usually forms during an uptrend as a continuation pattern. Underline the word continuation pattern. There are instances where ascending triangles form as a reversal pattern at the end of a downtrend, but they are typically continuation patterns. So we all agree with each other. They are a continuation pattern. So the one on the Australian market, I'd be surprised. I mean, we can't see into the future. I'd be surprised if it broke down. Sometimes you might get a little bit of a false break to the downside to suck in the amateurs, and then she sharply breaks up. That usually happens intraday, and upsets everyone. But from an investor's perspective, absolutely zero problems in this market, and I'm very confident with Mr. Bush's maneuvering, economically speaking, that the US market is in a period of ongoing upward movement. I won't make comment about all the other stories about this guy, but I think he's had a game plan that actually has worked for the US at least. It has worked to the detriment of most other countries except Australia. I don't know what happened. I don't know what Malcolm done, but we're one of the few countries that are not in his sights. I think it's probably connected to the military presence in Darwin and our position in the Asia Pacific. It'll have to be something very significant for him not to target us. So this is all good. Okay, let's just go have a look at other aspects of the market in terms of the strength of markets, because as investors, as this pullback occurs, that's the point in time where you should be positioning yourself to take advantage of the strongest sectors within the markets. And the best picture I could give you, just give me one moment, is obviously a rotation graph. First of all, the Australian market, which I continually make comment is completely different to the US market. The Australian market has a very high participation of sectors, and sectors that were horrible are now showing strength. Note finance. We've talked about this endlessly. And as this particular black line did a curvy right rotation, you would have expected to see, as you have done, a pattern which represents accumulation. So in case anyone's missed it, we could look at XFJ or we can look at CBA and their respective patterns that represent what I just said. So if I just move across to XXJ, which is finance minus REITs, probably the cleanest of the lot, that's what we have. So that is suggesting that we've got the beginning of a fairly big expansion within the banking sector, within the financial sector of the Australian market at least, and it's a good time to invest. And I told you I got in there weeks ago with the expectation of that market breaking above the trend line and continuing on for days, weeks and months. If XXJ looks like that, the biggest banks in Australia will look very similar. And the biggest bank in Australia is CBA, and it does look very similar, putting in what I would suggest to you at this point in time is a textbook inverted head and shoulders pattern, which has been in the past month breaking trend. This is, for those of you holding portfolios, the time to be invested and exposed to the banks. And I haven't said that, as you know, for a long, long time because I was out of banks for years, but now's the time to re-engage as the Royal Commission winds down. Banks have been dramatically changed in the way they do business, and there's ongoing public relation announcements about the way they are now working with clients and becoming a little bit more transparent and treating their customers with a little bit more respect. That appears to be hopefully the function and the result of our Royal Commission. So finance is looking great. Coming back to the sector rotation chart. Just again, I just want to make the comments that everything on this chart is strong. Even telecoms in the last 2 weeks, they've done what I personally would suggest is something that would attract my attention. I haven't even looked at telecoms, but while we're talking about it, let's go have a look. It should be in the embryonic stages of potentially doing something. Just give me a look. Haven't had a look before. Telecoms. Okay. So when I look at telecoms, when you look at this chart, all as you see, maybe I'll go to a weekly chart. This is interesting because it's in its, I use that word intent, embryonic. In this chart, what do you see? All as you see is a downward moving index, yeah? But if we go down to a daily chart, as Alan has just pointed out as I'm talking, there is a inverted head and shoulders. It's not a classic inverted head and shoulders pattern, but it suggests that we have something happening within the telecom sector. Now, the telecom sector is a really small sector within the Australian market. I can't get too excited about it, but there is New Zealand telecoms within our market, which maybe are exciting. I don't like Telstra, and although that said, here it is, it's got an inverted head and shoulders pattern. Alan, what's the New Zealand telecom company in Australia? I just can't think of its code. If you know it, you can type it in for me, and I'll just, because the strength, Spark, I'm going to guess it's SPK. I don't know the code. SPK-ISX. The strength has to be coming from somewhere, and that's correct. Oh, here it is. And guess what? The New Zealanders are saving us again. So here we go. So it is a really thin grouping of shares, but only a few of them dominate, and this is probably the one that's driving the comparative relative performance of the market. And it's had some dramatic moves in the past month. Am I going to get too interested in telecoms? No, I'm not. I've got much more interesting things to do. I like to concentrate my focus on other stuff, but it is something that you now could look at if you are focused on telecoms as a result of looking at this chart. So in terms of participation, I'm just looking for something that's not participating. There is 9 out of 10, let's call it 9 out of 10 sectors of the local market that are participating in the index in terms of looking strong. And what that tells me is that pent up energy within the choppiness index and the triangular pattern, when we have a break, it's probably going to be significant. It's probably going to be really sharp, and it's going to be a broadly based move up, supported by all sectors. That's what that chart's telling me at the moment. Of course, we can see metals and mining, which we need to support the market. But a couple of weeks ago, I said to you, this is probably going to do a strong right rotation. That's what I was expecting. And yes, it's lost a lot of strength. That's XMJ and XMM. But it looks like potentially that rotation has already started. If this rotation goes around in the next 2 weeks, that is a buy. If you're not in it, that's a buy on metals and mining. So it hasn't gone into the weakening quadrant. Now that is very interesting what we're looking at there. In fact, it's worthy of going and having a look at XMM. That is the metals and mining chart within the Australian context. It's also not in an ascending triangle, it's in a declining triangle, and it's popped back in the triangle, but that's fine. It is a flag, if I drew it beautifully, flag type pattern, which is normally again a continuation pattern, and it's nearly reached 75% of the depth of the pattern, and so it's still got a little bit to go. So don't sell if you've got metals and mining stocks, you've been concerned, I wouldn't be selling them. Definitely not Australian shares. especially when we do an analysis of the Australian currency and we note that maybe the Australian currency, if it's still in decline, is supporting an upward move in commodities, because most commodity contracts are US based or written in US dollars. Therefore, anything that's earning overseas currency is doing great things because they are holding US currency. They're Australian companies earning US dollars. Okay, so metals and mining is looking great. Not looking great, but it's looking solid. It's evolving. Um, Finance is looking great. They're the two ones I really keep my focus in on. But the leader and the continuing leader of this market is still healthcare, and it just keeps on moving to the upside. I don't look at my healthcare stocks very often, but just because I mentioned it, let me go have a look. In fact, I try not to look at my portfolio too often. What's the point of it? Still going to be there. Yeah, it's had a pullback. RMD, COH, looking good. CSL, looking good. ANN, Ansell, looking great. And SHL, looking fantastic. I mean, there's trades there. See this beautiful trade, just pulling back to the average, finding support on its trend line, should break up in the not too distant future as the index breaks. Some of these really strong stocks will break. So if you're a trader and not an investor, where should you be looking? You should be looking in healthcare. Healthcare is the strongest sector in the market. They're the shares that have the strongest rate of change of price movement, and that's where you should be going for a trade. And I mean trade options if they're available, and or trade shares short term as each of these legs go up. That's where I would be hunting for an opportunity. Before I move off our market too quickly, Alan just put in just another code for me just to have a quick look at. It's stepping slightly back to the discussion of telecoms, but before I move too quickly, let's just go have a look. The code is VOC for those that are telecom focused. Yeah, look, that's interesting. I'm not going to do any volume work on this. It's built a big base. Okay, it's a dog, has been a dog, but looks like it's building a base. Again, I prefer to put my money in high momentum stocks that are moving. As a trader, that's where the money is. This could continue for days, weeks, and months going sideways. Even with a fundamental underpinning, doesn't excite me from a technical perspective. Just while I'm just reading comments put in by Alan, Rio reported that it missed earnings. Okay, so let's go have a look at Rio and see the effect of their missed or their earnings report miss. If you've got a black screen, okay, so that must have been today, was it, Ellen? So she's gapped down, absolutely fine. Not a drama. I mean, that's fine. It's still maintaining its trend. And you could draw a trend line on Rio. And it's looking pretty good. It has broken below or just touched its trend line. Okay, while I'm on the Australian market, there was a question asked to have a review of the ANZ. Okay, so let me just type in ANZ while I'm on Australia. And it is a upward moving stock in very low momentum. So if you were to ask me, would I trade ANZ or would I trade one of the healthcare shares? I think you know the answer. I would trade one of the healthcare shares. Let me just pull up a rotation chart. I can type in ANZ. And I can type in something like COH. Okay, I'm going to turn all this off. This is a bit of fun. I'm going to put COH against ANZ. Okay, so which is the strongest share on the screen? It's clearly COH, dramatically stronger than ANZ, and has been for an awful amount of time. In fact, I don't want to get into teaching mode, but it's extremely strong. That's what this chart says. And ANZ has the potential for ongoing slight weakness, according to this particular chart. So definitely target the healthcare stocks if you're the trader. Okay, let's quickly shift across to the United States. I've made note the United States is a very different picture. There is evolving sectors that have been weak for a long time. Probably the best evolving grouping is the staple sector. And this tells me that this is one of those opportunities that you can't see, and it's just beginning. I believe I put up a few consumer staple stocks. I'm just going to dig them out if I can find them. I may not be able to find them quickly if I didn't label them. Ah, here they go. So companies like COST, grinding its way upwards. Companies like SYY. Ooh, look at that. Huge fall. Companies like EL. These are all consumer staple stocks, not really taking off. So that's at its beginning. You'd hunt around looking for new opportunity within that sector. So the difference between this chart and the Australian chart is there are many sectors, like finance, industrials, materials, telecoms. So we've got about 5 sectors that aren't really participating within this market. I just picked up something, healthcare within the United States. That tells me healthcare is about to have a big move, expanding data points, going into the green area very quickly. I'm just going to jump across to shares that I own on the United States healthcare sector, and that's about all I'll do. So I've only got 4 stocks. I've got GTHX, looking very sweet, breaking into a new high. BGNE, it's had a pullback, but looking fine. PTCT, looking fine. It's grinding its way up. ADAP, ouch, that's got a problem, and I wish I'd have picked it up before. But I'll see what happens in this next expansion. Maybe I'll need to shed that particular stock. In terms of the rest of the chart, I'm just making the point. This is it's not a broad-based participation within the market. Tech and consumer discretionary has led the charge in this market, but it looks like some leadership may occur in the very near future from healthcare. So it's not bad. It's just not like our Australian market. Coming across to other elements, basically currencies is what I want to look at. Coming across to FXA, which is obviously the Australian currency within the form of an exchange traded fund. Just pulling it up. Just give me one moment. Okay, very quickly, I'm going to jump across to the weekly chart as I do because I want to see its general trend. And we understand in the past couple of years, we've seen this general upward trend, low momentum move within the Australian market. We're all very well aware that it broke out of that channel. And on a daily chart, it has been doing extensions which have equaled each other. The key or the question that needs to be answered is, if it has done 100% extension of its previous range, which it has, and it's going up at the present time, is that a low? My answer can only be found within its volume behavior, and the answer is I don't think so. The volume, as in institutional buying volume, has completely dried up. So I would not be surprised to see, if I could just get control of my charts, I would not be surprised to see what appears to be a counter trend. And I'm going to start drawing some patterns in here. So it did a low. It did a retest of the low. It tried to break into a new high, but it looks like it's about to fail. That failure of the short-term trend line and that failure to produce any discernible accumulation pattern, along with its volume behavior, would indicate a continuing ongoing decline within the Australian dollar. If there's an ongoing decline within the Australian dollar, we should see the reverse with the US dollar. What we should be seeing is an upward moving US dollar ASX chart. And as I bring up the chart, it's a blank chart. I've deleted everything from last week by accident. I see it's maintaining its upward trend. I see that the market's come back. It's had a test of that trend line. It's had a retest of that trend line. Hasn't broken up just yet. Look at the volume behavior of USD. It's slightly positive. One moment, I need a drink, sorry. Slightly positive, therefore, it looks like the trend is in place. An increasing, strengthening US dollar as all other currency pairs will weaken against this move. If the US dollar is increasing and a currency, we could look at many, are declining, one other currency, which is a pseudo currency, is gold, starting with the weekly chart. If it's negative currencies against US dollar, I could only suggest to you that this low momentum move, which we are well aware broke out of its channel many, many weeks ago, is most likely to do what? Let's look at the volume. FXA has had a significant decline in buying volumes in the past week. Therefore, I would suggest to you that what you're seeing on screen is an ongoing, slow but sure deterioration of the gold market in alignment with what we're seeing. It's inverse the US dollar. It is doing these extensions, which are not exactly equal to each other, but not too far off. So it wouldn't be too hard to anticipate that if this continues, we might be seeing this particular GLD index down at 113 in the not too distant future. So interesting. Just coming back to FXA, just give me one moment. I just need to closely examine that. Yep, I've already mentioned it. I just on my pad, I had about to fail both in pattern and volume. I'm just tracking back to what I said last week. Last week I said more selling volume, going back 3 weeks ago. No, I didn't say anything 3 weeks ago. Okay, so I think that's fairly consistent. I'm just going quiet while I look at my notes. One moment. I do still look at robotics and artificial intelligence, but there's just nothing to get me excited about it. So I've avoided, although I analyze it, it's just drifting sideways. There's nothing to get me focused in on that particular area of the market. I've just got one last point to make on the metals and mining market. The Australian metals and mining looks kind of strong, but then when I start to look at global markets through the eyes of XME, which is the US Metals and Mining Index, there's a little bit of concern on this, and maybe the concern is founded if the Chinese market has a break to the downside. Maybe the Aussie chart does break out to the downside. So this is threatening to break trend. And the concern is that the volume behavior of XME has turned negative. And that usually leads to a break of trend. That's what tells me that a market's not going to be supported. And that would be, as I said, in alignment with the Chinese market. It's coming across back to the Australian XMM. So remember, there's different forces at play. So in the context of this chart, there is a currency effect on this chart, and that is a declining Australian dollar. And it's in a descending triangular pattern. Could it break out of this to the downside? It can do whatever it wants, but it hasn't done it yet. So I wouldn't particularly react just at the moment, because the negative pressure from overseas could be offset by a decline in our currency, and she can track sideways for another few months and then break to the upside in the future. So just want to add a few comments there. Just checking the time. I think I have spoken enough. Just give me one moment. I need to check my question panel. Okay, I think I've done it all. That's it for this evening. Michael promised to send you an email. If you don't get an email from me within a day, please chase me. Thanks very much, and I look forward to seeing everyone same time next week. Have a great evening. Good night.